Guys, today we have on Noah Goldberg, who is a partner
Yes.
partner at Theia Research. I had on his other partner, Felipe, before to talk about liquid markets. I read a lot of what Noah says on Twitter. I think he has a good perspective, especially from the liquid investing side. So, feel free to introduce yourself. Tell us maybe your background. I think you've been in crypto pretty much your whole career. And then, we could talk a little bit about what Theia does. Again, I have had your partner on, so definitely recommend going and listening to that. And we're going to talk about some different stuff today. But welcome, Noah.
Great to be here. So I'll start with some context on myself, briefly get some context on Theia, and you can kind of take it from there. So my background, slightly long-winded. I started trading CSGO skins in middle school. I think that's like a common background for a lot of people that got into crypto, and started doing like cross-exchange arbitrage when there were different venues that were popping up. And through that, started like cashing out CSGO skins into PayPal and eventually Bitcoin, Ethereum when that became popular. And that was one of a few different introductions that I had into crypto initially. Went to college to get a finance degree and ran the university's blockchain club for a few years, where I taught investing in crypto to college students. The lesson was primarily only invest in Bitcoin. And ran a small family and friends fund for a few years on chain during DeFi summer into 2021. Then worked at RadFi, a crypto fund primarily focused on chain finance, on their investment team for a couple of years before joining Theia about a year and a half ago. So I've spent my relatively short career on the investment teams of both the liquid and venture side of the crypto industry. On Theia, we are a liquid token fund, team of three, backgrounds, a mixture of crypto venture and private equity. And our approach is to take long-term concentrated positions in on-chain financial primitives and work closely with the teams that we invest in to realize fundamental growth in the KPIs based on forward-looking model that we build. So very similar to how long-term investing would be done in public equity markets, for example.
Very nice. Yeah. So why liquid? I mean, just to begin with, I mean, obviously, you said you had some people with venture background. What was what in your mind? What was the upside of liquid?
So there's the question, why did I get into liquid? And then there's the question, why Theia is focused on liquid. I'll preface by saying that on the Theia side, I didn't join Theia when it was first founded. And so the token fund, when I joined, had been around for 2 years, and John and Felipe had been managing that full time, and the structure was liquid. So I can kind of give my perspective on why they started a liquid token fund. But I'll also give my perspective as to why I focused on liquid. Part of it is that's kind of where my edge is. Like, I started trading CSGO skins where you have large bid-ask spreads in relatively inefficient markets. And I got into crypto under the same premise where, yes, it's great to be intelligent and try to trade a competitive market, but it's much easier to trade an uncompetitive market. And so that was kind of my premise behind how I thought about markets in general. Like, I really just wanted to find what is the most inefficient market where there's essentially easy money to be had by being better than whoever the competitors are. As far as why Theia is focused on liquid tokens, I think when you look back at when the fund was started in 2022, the industry looked much different than it does today. Since then, I think Theia has positioned itself well and continue to take advantage of liquid opportunities. But ultimately, I think the reason why we have a liquid token fund is because when the fund was started, the liquid token market was continuing to grow at a relatively rapid pace. The instruments that we're generally focused on are on-chain financial primitives. That's where we have a particular interest and thesis in investing. And those companies at the time were primarily launching tokens. Since then, that's changed a bit. There are still a lot of tokens being launched associated with financial primitives, but there are a lot of companies that are choosing to stay as pure equity plays. And so it's definitely a question in the future how we think about fund structuring. But at least today, we're comfortable operating a liquid token fund just because there are enough opportunities for us, and the market is still relatively inefficient.
No, that sounds good. When you talk about the companies now sort of transitioning to some extent to being less pure token plays and moving in the equity direction, can you give us just like from your perspective, a bit of a background, just historical background, maybe, I don't know how far back you want to go on just sort of the history of token markets in general, and then maybe also why you do think there are companies focused more on building pure equity, products at this juncture?
Yeah, so I think a lot of it stems from kind of the inception of the industry and first 7 or so years. So, 15 years ago, we had the creation of Bitcoin. In 2015, we had the creation of Ethereum and smart contract layer on top of blockchain technology. And then 2016, 17, we had kind of the ICO boom where a ton of companies realized that given that there were a few examples of projects that had lofty valuations on their tokens and were able to raise considerable crowdfunding, that this was a viable stream to raising capital and going public in some sense. And a lot of the companies that went public tokens that launched in 2017 turned out to not really have any value. But I think the reason why they initially launched was a function of the ease of the ability to raise capital and perhaps some like fundamental view on the premise of blockchain technology solving certain technological issues. After 2017, the smart contract layer continued to develop. There were things like CryptoKitties on the NFT side. You had like Ether Delta and some decentralized exchanges during that time. They didn't have tokens, but there was the ability to trade on a decentralized exchange. And so as the infrastructure continued to build out, there was a history of being able to raise capital via tokens. I don't know at what point the industry felt that the application layer needed to be decentralized, but given the ethos of the kind of original group of investors in the space, it's not like it makes sense, I guess, that was the view. And so there was that other additional reason to launching a token. And then finally, like when tokens started to trade at massive premiums after DeFi summer, there was a great comp. Not only could you raise a lot of capital, but the valuations that you were getting were astronomical relative to what a company with like the same fundamentals of these tokens would have if they didn't have a public instrument. And so you had a lot of venture capitalists come to the space. You had a lot of founders that wanted to launch tokens. It was essentially kind of all attempting to go after this free money. So my view of kind of where tokens lie today and why we use tokens is mostly a function of the implicit low cost of capital for raising, and then also the like premium to what an equity would have, and then to some extent perhaps like the liquid instrument, the ability to exit much quicker than you would get in a normal startup. And those are kind of the three dynamics at play that have historically kind of allowed people to launch tokens and have driven a lot of interest in more recent years.
Maybe you could dig a little bit more into that idea of a token premium. I always am curious as to what exactly, well, I think I have some understanding of what that means. I mean, I know what it means, what you were saying in the context of, compared to a publicly comped company, it's trading at some, massive order of magnitude higher. So I can see it in practice, but I'm kind of curious. One, maybe how do you guys approach that? How does a fund like yourself take into account this, there's some massive premium put on these, and then how are you identifying value when you sort of know that to be a truth,
So let me take a step back first. I'll answer that question, but I think it's important to address like what the token premium is and kind of my view of where it will go. So at a high level, like when you think about society that's driven by capitalism, like a lot of the entrepreneurial decisions that are made are a function of expected value relative to the span of all entrepreneurial opportunities in the world. And so I think what the token premium is it's the highest expected value required, or it's a above average expected value relative to the inputs required to achieve that expected value. And so as someone that is thinking purely from a financial perspective, if I have anything in the world to do from a capitalistic venture perspective, I'm going to launch a token because it requires the least amount of work for me for the most amount of upside. I think like the other lens on token premium is to use tokens versus equities, because that's the traditional instrument that companies at early stage typically use. And so the other example would just be if a company is able to raise it $10 million post money using an equity instrument and is able to raise it $20 million using a token instrument, the difference between the two in percentage or absolute values is kind of this token premium. And when you have a token premium, it, regardless of whether there's like the underlying business needs a token, there is some interest in launching a token because it provides the lowest cost of capital. And so you find teams and investors and various potential stakeholders finding ways to justify inserting tokens into businesses because of this premise. And so when you think about the supply and demand dynamics that allow for a token premium, and we can go into detail on both sides, long term, the token premium is unsustainable. We could argue of like how long it will be sustained, but I can say with the utmost certainty that it will not sustain itself, because if it were to sustain itself, the world would move to only launching tokens as the only form of capital raising. And I think we all have like a general inclination on like the progress that teams on average that launch tokens have relative to other types of instruments and kind of market segments in the world.
Well, I guess there is some argument that, I mean, the idealistic, a hyper, bullish crypto person would say that's the future, that all companies are launching tokens. But I think what you're saying and why I think both could theoretically be true is that, okay, but there's not going to be some 100x premium as a function of it being a token. It's just changing the form factor of an instrument that we already have and have had for hundreds of years, which are, private or public equities. Like that would be the distinction that I would make. So I don't know, but okay. So go ahead as to why you think like this is clearly unsustainable. I mean, obviously I agree, but I'm curious, like what is your rationale for, this delta between all companies launching tokens versus, just some, and then the difference between the prices that can be garnered there. Like, what is the best explanation in your mind for this?
So I guess the supply side is pretty easy to understand just from the perspective of, as a creator of a token, you are getting an exit that you would not be able to get if you launch an equity. That applies to founders and investors and kind of all stakeholders. So you have a lot of founders come to market attempting to raise, and you have a lot of VCs creating token funds initially when the token premium is the highest. Like that would be the initial supply side dynamic at play. You would just kind of continue to flood the market to take advantage of the premium and raise more capital and continue to do it as it allows. So the question is, what happens on the demand side? Just because I think that has a bit more variability. And that's just to say, like, the token premium is at zero. All of a sudden, the supply side changes its dynamics, but token premium somehow has to get there. And so it's almost entirely on the demand side, putting aside like some type of regulatory intervention. And so first question is, why does the demand side allow the token premium to exist? There's a few reasons. One, you have highly valued comps. So like Bitcoin is one of the largest assets in the world. That was the comp for a lot of L1s that were launching in 2017 to 2021. And then you had like L2s come out that were comped against L1s. You had a few like DeFi blue chips that had really high valuations in 2021 that people comped to. It's just to say, like, people found a way to see the highest valued comp and say, I can achieve this, and therefore it makes sense to invest at X valuation. So that's one possible explanation. The second is that in 2021, taking a step back 4 years, the perspective of a lot of people in the market was that like blockchain was imminently going to take over traditional finance. Maybe I'm projecting my own views at the time, but I do think that people were very optimistic at that point in time on the fundamental progress that was going to that was going to occur.
I think that's fair. Yeah.
And so like they were willing to pay high multiples because they assumed the growth rate was going to be higher. Um, and then the third reason, and this has become much more relevant in today's market than it was a few years ago, but it's worth discussing, is that a large portion of the token holders or traders that were attracted to crypto have no sense of fundamental value, and in many cases are trading price. And so it's a lot of momentum trading, quant trading, a lot of people that have poker backgrounds, and there's nothing wrong with that. If the money is there to be had, they should go and try to get it. But it's just to say the people that are pushing around price on the demand side are willing to pay up beyond what fair value is, because they're not trying to exit based on some fundamental view. It's kind of oh, this token TG'd at $1, it went down 50 cents because the airdropped a bunch of supply. I bet I could trade it back up to $1, and that's efficient. So I think those are some of many reasons as to why the demand side is allowed for tokens to trade at high valuations. And as far as where we stand today, maybe this is less clear to certain points or parts of the market, but I think I have a fairly good view of the liquid token markets. And regardless of what the token prices are saying, the markets are slowly kind of dying. And that's all to say, the total amount of participants in the markets that are trading tokens, it's coming down, at least on the retail side. Retail used to be the dominant producer of volume on centralized exchanges in 2021, and now that's no longer true. When you see tokens get launched these days, they there are some outliers, but they tend to go down in value much more rapidly and are harder to sustain higher valuations. And so this token premium is dying one way or another. We can argue how long it's going to take, but I think the market needs to acknowledge that a lot of people are disillusioned on the fundamental progress that's being made. And while these valuations allow for comps and allow for people to say look at the things we're creating, it's it's not actual fundamental value. So yeah, I guess maybe I'll stop there. I have some other thoughts.
Good.
But
that's good. I want to go back to it for a second, though. You said that, and this is just somewhat of a side note, you said that in 2021, a lot of us, I don't know, I don't know if I would include myself, and I don't necessarily want to include you, but a lot of the community, let's say, thought that DeFi blockchains were going to supplant traditional finance, and it would be swifter than we've since observed. What do you think is the best explanation? This is more just, this is more of a philosophical question or whatever. So you just run with this however you want. But what is the best explanation for why this hasn't played out, at least to the extent or with the speed at, which we may have assumed back when we first saw somebody write X times Y equals K or whatever,
So I'll preface by saying that I work at a long only fund that invests only in on-chain financial tokens. So I do believe in the thesis, but that doesn't detract from what things should be priced at and the market structure at hand. And so I think part of it is that when projects came to market and they generated a lot of traction, the traction was real, but it wasn't on high quality assets. For example, when Uniswap was created, tokens that came on Uniswap and were traded, they weren't high quality assets. So it wasn't realistic to yeah, it wasn't realistic to underrate the volume Uniswap was creating and comp it to the NASDAQ and say, oh, well, this is 10% of NASDAQ, then it should be 10% of NASDAQ valuation. So I think part of it was the KPIs for on-chain finance exploded super rapidly on tech that probably wasn't fully fleshed out, but worked at the time. I mean, I was paying, $100 per transaction on gas fees back in 2021. Right. So you did what you needed to do because the money was there to be had. I think besides people getting over optimistic based on KPIs that were unsustainable, the next piece is that there was a lot of infrastructure that did need to be built out in certain respects. For example, on the wallet side, I think wallet as a service at this point is well understood as a good distribution mechanism. But before then, there wasn't a great way for retail apps to have embedded wallets and allow people to use an email sign-on, for example. And that's not to say that's what changes on-chain finance, but I could think of tons of these different things. Like the way that orders were being processed on the Ethereum L1 just allowed a lot of value leakage. There are a lot of different things that needed to be improved, and it was naturally going to take a lot of time to improve them. I think the last thing that I'll mention on this side of things is that specifically for finance, regulation does play a critical role of unlocking certain market participants' ability to access markets. And so I think that people in crypto assume that we could kind of build and they would come. And you can see that as far as like the ethos that allowed people to think that like decentralization of an application from day one would make sense, and that they shouldn't have like corporate entities that can interface with institutions. Like these decisions didn't make sense, and they'd assumed that institutions would just conform to like figure out how to interact with crypto. But it's a combination of the two, and certainly it's, at least today, it's much more skewed towards crypto needing to find a way to interface with like the traditional markets, not vice versa. So I think those are kind of the three reasons as to why people were more optimistic around the timing than how it played out in reality. And to some extent, there is some outcome bias because, for example, like I don't think anybody could have predicted that Gary Gensler was going to come into the space and make regulatory very difficult for 4 years.
Yeah, that's fair. I wanted to go back. One other question I had with, and it's sort of again related to what you were saying. I think there's this idea that this token premium exists because there's some scenarios where there's kind of guaranteed liquidity. That is debatable. I get into arguments with people, but oftentimes there is some version of you will be able to make this investment liquid. So that's one side of it. There's another side, which I don't know how overlapping it is, but it's certainly related. And it kind of goes to the point you were making about being able to expand assets to people who may never have had access to them. But I think about this, and I'm curious your thoughts, because there's this idea, well, look, if we can open up, a market to the rest of the whole world, right, that may not have had access to quality. Hang on, I'm saying quality here, but don't read too much into that. To quality assets, that just by nature, expands the total addressable market. And I guess the question I'm asking is, that seems at first glance, it seems kind of intuitive, but then the more I think about it, the more I kind of wonder what that actually means or where that falls in the long run. And so like an example I would give, and this is an extreme example, and I'm obviously going to use a troll-esque extreme example, but like providing people the ability to invest in Jelly Jelly didn't make Jelly Jelly some, next S&P 500 company. And so it doesn't necessarily change the nature of these assets. Like the whole world having access to them, that's one thing, but it doesn't necessarily change like the value proposition or the fundamental value proposition of these assets. So I'm kind of curious, like how much I got this from talking with Guy from Athena, right? And like one of his arguments, which I think is a valid one, but I'm just curious your thoughts, is like, look, the entire world can invest in this and the entire world can't use Robinhood necessarily. There should be, some premium put on it, but it doesn't really necessarily change how much these companies make, right? So I'm kind of curious, like, where do you think that falls into it? Just expanding the investor base, if you will, in terms of the token premium.
So there is a mechanical argument. So like, for example, in OTC equity markets, you tend to find lower valuations, putting aside quality of business. And the reason is because there's a liquidity discount associated with these companies. Like it's hard to trade in and out. And so the largest funds that would make the markets are not able to, because they aren't realistically able to move in and out of the positions as well as they would. So in theory, like if a company didn't have a liquid instrument or had an liquid instrument, put it on chain and it became more liquid, like their ability to raise capital would increase or at their like current cost capital. So like I think that in like theoretically speaking, there is some validity to the argument that like increasing liquidity, increasing access does lead to higher valuations. But I think it's from the perspective of something that's already being handicapped by its liquidity, not something that is liquid and you're making it even more liquid. So for example, you
yeah.
can't just take equities on the NASDAQ, put them on chain and expect them to trade a premium. I can tell you with like pretty high confidence that won't occur. And the reason it won't occur is because the people that are pricing the assets on the NASDAQ have a very large pool of capital. They understand what the cost of capital is. And the cost of capital is not inserting some type of liquidity discount. So like the liquidity factor shouldn't change their opinion. Like if the argument is there are these like large pools of capital that don't have access to the NASDAQ and are willing to underwrite a higher valuation for like some unreasonable like or non-fundamental reason, then so be it. But it's not fundamental as to like why you put something on blockchain, it's globally accessible, and like the multiple you're willing to pay goes up.
Yeah. Okay, so then let's shift a little bit. Maybe help us delineate between how you invest in tokens, and I'm actually curious in this question. Infrastructure applications, where like what is your overarching thesis? Then we can dig in a little bit more.
I think the first thing to point out is that all of us at Theia have a similar perspective that we want to own equity. We want to be aligned with the founders of companies. That being said, we do understand the nuances of how liquid tokens have been created. So like there is some legacy structuring issues. And then I guess to a lesser extent, like there are some questions around like whether these tokens actually accrue value to the owners. But the North Star for us is we want to invest in the business, and the tokens that we're investing in, we believe to be the key vehicles that represent the upside in the business. That's to say that like the companies we're investing in, they generally don't have equity entities with outside ownership. Maybe they have Cayman Foundation, but it's a nonprofit, and perhaps there's some like written bylaws that say that like capital is going to be allocated to token holders, or the decisions of capital allocation are decided by token holders. The teams typically are being issued tokens as incentives and do not have equity ownership. Like the point that I'm getting across is the first step for us is making sure that we're aligned on the fundamental business value that's being created, leading to price appreciation in the asset that we hold, and making sure that because of the like regulatory nuances of crypto, we are protected across enough of our bases to feel comfortable with the fact that like this token does not like explicitly represent equity. So after going through that, the second piece, like investing in businesses with good fundamentals, trading at low valuations, that's kind of our bread and butter. And the way that we look at what the true like a fair valuation is based on free cash flow in the future, discounted at the present. Same as kind of every other investor would look at equities. And so we're mostly focused on applications just because applications typically are much more like revenue focused or fundamentally focused. I think infrastructure projects have not had to be as cash flow or unit economic focused. So it's harder for us to build like valuation models that we feel comfortable with. We're also only focused on on-chain finance. So from an end market mandate perspective, there are only applications. I guess we could argue some of it is infrastructure. But the businesses all look pretty similar to traditional financial businesses with slight nuances. So things like lending, exchange, derivatives, etc. And those all have pretty clear valuation models to use. And so we're just using those valuation models and discounting by relatively high cost of capital because, like, one, there's a lot of volatility in what the future looks like for this technology. And two, the instruments that we're investing in aren't equity and should have a additional risk premium associated for them.
Yeah, that makes sense. Do you think you can apply, discounted cash flow models to infrastructure projects, however you define that? I've talked to Felipe about this. I think I don't know if we completely agree, but I'm curious, like, what your argument would be there.
It depends. Like, in theory, yes. Like, if I have an infrastructure project, they're charging, or like take a bridge. Like, let's say I'm not necessarily asset bridging. It could just be like arbitrary message bridging, like layer 0 wormhole, etc. Like they charge a base fee. They could always just decide like we're gonna 2x the cost because we were just passing on costs to our customers. We could 2x them, and we could charge that in USD, and we could pass that back to token holders. So in theory, like if they did that, then the model is easy enough for me to create. I'm just saying like what percent market share do they have in the future? How large is the bridging market? How much revenue does that represent, and kind of discounting it to the present. I'd imagine that like one of your pieces of pushback against like infrastructure valuations that is very circular. Like typically the revenue is partially a function of token price, or in many cases, like the token acts as like the means of payment for the infrastructure. I still think that means it can be valued. I just think that the valuation model becomes overly complex to the point where like I'm not going to play that game. But like you're basically like playing a multi-factor model where one of the factors changes the other factors as inputs. So like if token goes up to X, how does that change the traction? What will the traction lead to the token that is trading now at X going down or going up? Like you would have to play that game. It's not to say it's unmodelable, but it's very complex, and like I don't know how easily it can be done, but in theory it could be done.
Okay, what do you think about using REV for L1s?
Maybe a cop-out answer. Like I think REV is like directionally the right approach. I think like the question that should come to mind for all investors is how do you both optimize for revenue without like impacting user experience? And so like I do think that like while you have REV, and like that's probably, if I were to build a cash flow model for an L1, the way that I would approach it, I would also be assuming that like REV as a percent of transaction volumes is continuously compressing over time. And the only way that like the net REV increases over time is because transaction volumes are outpacing the decline in REV as a percent of transaction volumes. And I don't know whether that's a fair assumption, but that's how I would kind of view REV and trying to back into an L1 valuation.
Do you think that, so do you use that ever? I guess, like what? Well, first of all, do you invest in L1s? And to the extent that you do, how applicable is REV in that context?
We don't invest in L1s. We've held L1s as a means to get beta exposure to an ecosystem. So for example, Theia held Sol in like the back half of 2023 until like mid 2024, just because we had a view on Solana, but didn't have many applications that we felt particularly interested in investing in. And so use this as a way to express the beta. But with the hope of investing into the applications on Solana as those opportunities arose. And that's what we did. So it's just to say, like, we can hold Sol, we can hold ETH, we can hold other things, but it's not because we have like a super strong view on the valuation of these assets. It's more so perhaps a like non-consensus view of the traction, but that's not the game we typically play. So a small portion of the book can hold things like ETH and Sol, but we're not valuing them based on REV, and we don't look at them as necessarily like alpha producing names. And we typically try not to hold them. We prefer to always invest in the application layer if we have the choice. As far as like how we underwrite Sol versus ETH versus everything else, I mean, REV comes into play. Like in 2021, like I definitely was aware that the ETH sales multiple was like 10 to 20x. Like we can argue whether it was sustainable. Obviously wasn't, but like I knew what the multiple was, and I knew what you needed to believe to like make it sustainable. And if it can sustain that multiple, then it wasn't overpriced. So I think it depends on like what the magnitude of the multiple on REV is for me to like consider it. If it's like 100x or something where like it's just hard to kind of back into what I would need to believe, or like I don't have confidence anything like gets me to like a multiple that I feel comfortable with, then I can't really use it. And in general, like I haven't really used REV. But that's just because I don't play the game of like trying to value L1s. I think it's a hard game, and I let other people try to do it, honestly.
The Gwart Show is sponsored by Ellipsis Labs, who I've been following for 3 years now. They're one of the strongest teams I know in crypto. Ellipsis Labs is a small engineering team with a flat structure. They build complex systems, primarily in Rust. For engineers who like challenges, here's the kind of problem they solve. A layer 2 blockchain needs to maintain 100 million accounts and generate a state root after each transaction batch. The root must be built within 50 milliseconds. How would you design a system to ensure the root construction is fast enough? High-performance challenges are core to Ellipsis Labs' mission as they build modern crypto finance. They believe finance needs more than an upgrade. It needs a complete rewrite. The success of their first product, Phoenix V1, speaks for itself, doing over $70 billion in organic trading volume. Now, Ellipsis Labs is building Atlas, the blockchain purpose-built for verifiable finance. I know this team personally, and I like them because they're unique in the crypto space. They have a long-term focus, they work in person from their New York City headquarters, and they're here to build products that fundamentally change the world of finance. If you want to learn more about their open roles, go to ellipsislabs.xyz/careers.
What do you think these valuations are a function of? And I think the most obvious answer is what we were talking about before, comps. Like, Ethereum can go to 300 billion. Why can't Solana? Like that to me is oftentimes the most regurgitated thesis. But when I was talking to like Hasib, for example, last week, it was the first podcast we had. And I kind of nailed him down, why are you valuing, some chain at X? And he said REV. And I'm curious though, do you think that is what the market is actually valuing these things at? Because I don't think it is. I mean, it seems like very, very detached.
I don't think it is, and I think it depends on what valuation range and stage we're discussing, because I think like the methodology that's used changes. And I also think like if we're talking about venture participants versus liquid participants, that's a whole different story as well. But yeah, in general, I don't think that the market is currently priced on REV, although I wouldn't be surprised if there's correlation between like changes in REV and changes in price, just as a function of like activity being so correlated to price. I think that perhaps this is like quite cynical, but as far as like the venture backed like ecosystem blockchain projects, like there is a comp game, but the comp isn't Ethereum. It's more so like what are the other venture backed ecosystem comps that have come to market in the past 2 to 3 years and the valuations that I could exit at. So from that perspective, if on average they've been around like 1 to 5 billion, sometimes trade up to 10 billion, like you could probably justify entering at 250 to 500 million FDV as a venture fund if you think you can get that outcome in like 4 years. So like that math works. But it's less like a function of, do I believe in the project, more so like, do I believe in the market structure maintaining itself? I think like as projects come to market and liquid token investors look at them, it can be the same game, but they don't trade at 250 to 500 million for liquid markets to like kind of play the game of, can I get them to trade up to like the existing venture backed comps? And so in that case, if they come to market like 5 to 10 billion, I think a lot of people are saying, well, what if it's sold? I don't think ETH is the comp anymore. Partially because it's like trading closer and closer to SOL. But partially, I think like people in general don't believe it's easy to like recreate the ETH outcome. So a lot of like the L1s and L2s that come to market today, I think like are mostly comped against like SOL and sometimes SWE. And I'd imagine that SOL is comped against ETH, and ETH is comped against Bitcoin. So it is all circular and kind of stems from what are the highest market cap assets in the market. And then the last thing I'll add is that a lot of capital was raised by funds and other vehicles that have like at this point captive capital. And so that capital keeps a minimum market cap across a lot of liquid assets. So that's the other like game in hand, is that like until VCs are seeing their like total amount of capital come down or liquid token fund capital come down, you can have some confidence in the market structure of like, if I bring an L1 to market and it gets listed on Binance, it will trade within X to Y price.
Okay, that was a bit of a tangent, considering you guys aren't big L1 investors. Okay, I want to come back to applications here. You wrote this long post, one which I mainly agreed with, about Uniswap and the Unitoken. Like, could you kind of like break down what you were saying there, and then I'll probe a little bit more. It was with regards to like the Unitoken, how it should be comped, and like some of the reservations you had, and maybe it kind of goes to your point about a lot of the stuff being, maybe valued not as a function of its fundamentals and more just as a floating tradable coin.
Yeah, so I think the way that I was thinking about Uniswap is like, in theory, what do you need to believe for Uni to produce revenue? And if they produce revenue, pass it back to Uni, like what multiple are you paying? And how does that compare to other exchange businesses? And so like we can argue over those assumptions, but that was the initial framing. And so if they're producing, I don't remember exactly what it was, but the point is that like if you take the annual volume that they're producing, charge 1 BIP on top of it, maybe it's 2, maybe it's half a BIP, whatever it is, you get price of sales multiple that's like an order of magnitude larger than like any exchange that you would see in traditional markets. And so that's like the first point to point out, is that like Uni itself, even if it turned on the fee switch, would trade at a high valuation. The second piece is that like if you think about the enterprise value of Uni or like Uniswap, there is Unitoken and there is the Uniswap equity. And so while we can say like Uniswap as a whole could be worth this, there's a question of like what's Uni worth and what's the Uniswap equity worth and what's the difference between the two. So I think that's kind of the premise that I was getting at with the Unitoken, is that it's certainly not traded on anything fundamental. And we can go into like the different stakeholders that trade Uni and what their typical mindset is on like holding the position. But from a pricing perspective, there's not like a valuation case that makes Uni make fundamental sense to own today's price.
Yeah, but okay, so then let's just say all else equal. Let's put aside for a second that the Uni token's all screwy and it doesn't really represent the equity. Like let's just say that it does. Let's say that the Uni token is like, from the way that you guys invest, it would be a pure play in the sense that it's a true equity ownership of this entire thing. Okay. How should it be comped relative to something like Coinbase? Because that was the exchange you brought up. I think there's two arguments, and I'm interested. Well, from my perspective, two arguments. One argument is that, well, it's open to anyone, it's permissionless. Anyone in the world can use this. The total addressable market is X amount bigger, and so it should be trading at a higher valuation. The counter argument is this is open source or business source or whatever. It can be easily disintermediated. The capex and opex to create a competitor is relatively low. We've seen many competitors crop up, and we have seen Uniswap lose, at least relative to the early days, a large portion of its market share to competitors. It should trade at a much lower valuation. I'm interested in how you think in terms of how, again, assuming that it was true equity, how would you value something like Uni relative to Coinbase, Binance, a large public exchange?
It's a fair question. And my view on Uniswap and the valuation difference between it and like traditional equity businesses is similar to my view on a lot of the on-chain financial infrastructure versus its TradFi counterparts, which is just to say, like, the first like fundamental difference between Coinbase and Uniswap is that Coinbase is vertically integrated. They have licenses, they own the customer relationship, they have many product offerings. It's an insular financial ecosystem that its users are captive within. For Uniswap, many cases, they essentially just facilitate the exchange. So in theory, it's a portion of what Coinbase offers, and therefore it should trade at a discount. That's like one thing that comes to mind. The second is like the difference between Coinbase and Uniswap operationally is that Coinbase spends a lot more on compensation for employees, and that provides a moat. Like, I have a salesperson at Coinbase that I can reach out to and speak to, and that is substantial value add that it would cost Uniswap an arm and a leg to offer. I bring this up because I think a lot of fundamental investors will retort, like, Uniswap will have like 90% operating margins and Coinbase is 10%. Right. So therefore I'm willing to pay some high multiple. Like, maybe that's true, but like, you have to understand that the reason why they have high margins is because they're not doing all the things that the exchange or like the traditional exchanges are doing. And so like if they wanted to like compete with Coinbase directly, they definitely could, but they would have to probably spend much more on resources. And then thirdly, on Uniswap specifically, and I imagine it's something you're going to bring up, like although in theory, like you can turn on a fee switch, like because Uniswap doesn't own the customer, I don't remember the exact number that's going through the front end, but assume a large portion of like the Uniswap flows coming through routers, those like end users that are trading on CowSwap and somehow like being crossed against Uniswap flows, like the only reason they're getting crossed on that exchange is because Uniswap is competitive relative to every other venue. And so if you charge a fee on top of LPs, that reduces competitivity. If you cut directly into LP fees, there's a question of whether LPs are earning their required hurdle rate to provide liquidity. And so like there's a question of like, if I had a take on Uniswap, like will that degrade the exchange experience to a point where they're not competitive? I don't know the answer. I'm not an LP, but like I think that's like the other question on Uniswap is that like the way that the exchange pricing is done for LPs is not the same as how an order book model operates for Coinbase, NASDAQ, etc.
Okay, so then what is the moat? Like what are, I'm not talking about Uniswap here. I'm talking about in general. Like what are the moats when you go into invest in a token? Like what is a definable moat? Maybe this comes more from the application layer versus, eschewing the infrastructure here. Like what do you want to see? Distribution, owning that customer?
There's a lot of different moats that you can create. I think we could definitely argue on like sustainability of the moats, etc. But like one that comes to mind is like network economies. Like there are like considerable network effects to certain types of on-chain financial businesses. Like two that come to mind are like money markets and stablecoins. And like the proliferation of a single stablecoin increases its liquidity, so it's lower spreads.
Yeah.
Like you can have an Oracle pricing that comes up, so it can get listed on a bunch of exchanges. It can be used as like the pair type for LPs. So I think that's something on stablecoins and on lending. So like, Aave, Morpho, Camino, Euler, like all these products, in order to facilitate an 100 million USDC borrow, they need to have $100 million of capital on the lending protocol. In order to get $100 million of capital on the lending protocol, they probably already need to have borrowers so that the people depositing the 100 million like are earning something. And like as you scale that like borrow size up, there is a minimum amount of liquidity on the other side that you need to offer. There's a number of other benefits, and then also like on the same side of network economies for like using borrow lend protocols, there is a difference in cost of capital associated with brand. Like depositing on Aave is much lower risk than depositing on like XL2 like Aave fork. So those are a couple of things. There are some network or economies of scale, although it's less relevant in on-chain finance. And then like one thing that comes to mind is like counter positioning. So like Morpho did a really good job taking market share from Aave by creating a product that directly counter positioned against Aave, where it's essentially like we can create the most simple, isolated, immutable vault. So like those are some things that come to mind. I imagine you'll have pushback, so I'm happy to respond, but I'll start with that.
No, I mean, it's like I defer to, okay, we'll wait and see. Obviously, I have kind of going back to what you were saying originally, where we thought that we would supplant TradFi, and it turns out we're like figuring out ways to integrate ourselves more with TradFi now. A lot of what I see, and this isn't exactly the right way to say this, but a lot of what I see is more like it appears as though TradFi is more likely to copy us instead of adopt us. To the extent that they adopt us, it's not going to be, and I'm speaking very broadly here, when it seems that adoption is going to come only if it's low cost to them and very, very like big improvements to their tech stack or whatever you want to call it. And so I'm just skeptical that, I mean, I guess what I'm saying is I think there's a non-remote chance that 95% of the applications and primitives that have, like for example, tokens that represent their equity or whatever, are just not used in 5 years on the grounds that Robinhood just came in and made their own, or JP Morgan came in and made their own, or Goldman made their own. And so it's very hard because a lot of crypto thus far has been people who aren't actual financial, like they aren't the people moving real
amounts of financial capital across the world and like making improvements to, existing financial markets. They're degens, right? And a lot of what we have gleaned from crypto has been this group of highly speculative, highly risk on people. And it's like, this isn't actually what makes, financial markets go around, So I think there's the market still kind of under indexes on that being the case, in the sense that like, this is not the cohort that makes finance like around the world, And so that would be my reservation, why I just say, okay, we'll wait and see. I mean, but I think the liquidity like is one that it's real, is a clear moat. I just don't know what like the take rate or what the value proposition of that is in the long run. So I don't know if that's pushed back as much as like, we'll wait and see. It's easy to say we'll wait and see, right?
Yeah, no, I think that's fair. And as someone that has a cynical mindset, like I would otherwise be inclined to agree with you, but I kind of feel like we've crossed the chasm on certain components of the on-chain financial stack. But before I get to that, like I will say, like, don't get me wrong. I think if we're building for the 20,000 like on-chain crypto degens, like we failed as an industry. And I think like that group of degens is going to continue to shrink as like their ability to make money trading in the trenches continues to shrink as well. So like, yeah, I completely agree. Like the wrong set to build for. It's definitely created some like technical debt or like mindset debt. I don't know the right way to frame it.
Yeah. Philosophical debt.
Yeah. So with that in mind, like there is the innovator's dilemma that is going to restrict Goldman Sachs from coming on chain, just in that like there isn't a large revenue opportunity for them today. So like, yeah, you see BlackRock coming on and like getting Whittle into MakerDAO because it's a $500 million deal to just kind of have a conversation with the MakerDAO team and try to get it across the line. And that makes total sense. But as far as like getting them to build out like an Aave fork and try to take market share, it's not clear, partially because the revenue opportunity isn't clear today. And so the question is what's the order of operations? Like, does the revenue opportunity become so clear, but before the projects that are chasing after it achieve moats, that someone like Robinhood, Goldman Sachs, etc., comes in and just completely displaces them and offers the same service? Like, that's possible. That being said, I think we're continuing to see traction on specific verticals within on-chain finance that are going to make it difficult for these financial institutions to offer these products. And I also don't think they're going to want to. Like, I can feel pretty confident saying that none of the existing financial institutions, so call it like the BlackRocks of the world or the investment banks or the banks, are going to build like a over collateralized money market. We can argue whether like the over collateralized money market has value in the future.
Yeah, that was going to be my pushback. Is like, maybe it's like, I'm not trying to downplay Aave. Okay, I have done that. I'm too critical sometimes, and so I'll try to be nice here. But what is Aave, like functionally? What is Aave really used for? It's mainly used to get leverage to go and do other degenerate stuff. Like we need to be honest about like what the users here are doing. This is why I just think what you were talking about, like this mindset debt, right? It has its little tentacles like all the way down to the core. It's like, well, is over collateralized lending in this context that valuable? And then if you say, okay, well, what if we did something like a much more permissionless margin loans? Like you have to go and take out a loan on Schwab right now, and you can get margin if you have some account size. Okay, what if we could do that in a much more permissionless way? Well, okay, that is something that they own the ability to not issue but custody, even though they're not really the custodians. But regardless, they have the distribution of that asset to the end user. They'll just put that inside of their Schwab app. Like, so it is hard sometimes to see this massive unlock for something like Aave, and why I often joke, like, maybe we should at least consider that the total addressable market for Aave is the current users of Aave. Like, we should consider that a possibility. You see what I'm saying?
Yeah, for sure. I'm not arguing about like what the potential like variance and outcomes are like a few years forward, or what the probabilities are. I'm just kind of arguing. Like, actually, I'm willing to argue on the probabilities that I'm probably a little bit more optimistic than you. But as far as money markets, to your point, like let's take Charles Schwab as an example. Reg T margin is an $800 billion loan outstanding market size. And Reg T margin operates identically to Aave with some slight nuances. And that's just to say that it's instant liquidation if your loan falls below a specific LTV. And those prices are just a function of the market prices on the assets traded on the exchanges that Charles Schwab connects to. And so I agree with you, for example, like on Charles Schwab, there's a lot of different assets that I can post on Aave. It's Bitcoin, LSTs, whatever it might be. And so like there's an asset quality problem. And also like I think that a lot of the like current users of Aave aren't thinking like, oh, I want to get like a universal margin account. It's how do I like do a looping trade or like optimize for yields. Like I agree in the like upside universe that like the Aave or Morpho Camino like take over or take share from the 800 billion of loans outstanding. It's going to require more assets to come on chain. It's going to require Oracle prices for those assets, and it's going to require an improved UX layer that allows for me to just have some type of like vaults with all those assets sitting in it, and you get like a margin against that vault. So I think those are like all the things you have to believe to like kind of bridge from. There are probably other things too, but like to bridge from the current market structure to a market structure where like the Aaves of the world are facilitating margin loans. But I do think that's a reasonable possibility. And I think there are two reasons. One is like, what is the benefit of the margin loan on permissionless blockchains? Well, it's the 24/7 nature. Like there's a lot of jump risk associated with like margin on Reg T accounts between like Friday evening and Monday morning. And so like the ability to top up margin over the weekend is needed. Like we can argue like, are retail people interested in topping up margin? But let's not get into that. I'm just like giving you some examples. And then the other thing, and probably what I feel most confident in as to why it's worth making this bet, is that Charles Schwab and all of its competitors are playing a redundant game where they're all building insularly and it's all closed source. And for that reason, like they all have to compete against each other, like come to market with the product and then find out what each other have brought to market and see if there's something to copy. Like on-chain finance, although it's more competitive and perhaps that means the margins are going to be lower in the future, like the ability to take someone's code, improve it, and then just completely ruin their business is there. And on one hand, you could say that's a bug, but from an investor's perspective. But as far as like the progress of on-chain finance, in theory, because it's a market structure or it's an open market, it should have a faster pace of innovation. So those are some of like the points that I'll raise as to why I think like you can bridge from the current market structure to a market structure that would be like conducive to facilitate real economic activity, and then like why we could potentially get there. But I like think that the last thing I'll say on this is that like if the people in this industry continue to have this like idealistic mindset or like keep having these like philosophical views and not focusing on like being pragmatic and just delivering products, like they're not going to outpace like Charles Schwab. So, you know, there's definitely like a leap of faith you have to make to like get from where we are today to the case where on-chain finance is proliferated and facilitating a lot of actual or like valuable financial usage.
What are some improvements you'd like to see with existing liquid markets, tokenized equity? What are you optimistic about, maybe?
So I am optimistic on-chain finance. Part of it stems from me being so pessimistic towards like the traditional financial infrastructure, as well as like current fiat currencies, but that's somewhat of an aside. Within on-chain finance, I think I'm interested in a lot of things that I've talked about, which is just bridging from the current user base to the new user base and making sure that we're addressing the like problems that this new user base wants to solve. As far as like some of the things that are coming to market that I think represent this shift, like you have a lot of crypto-backed cards that have like pretty interesting self-custody policies with policy controls as to like reduce the potential for someone kind of robbing you of all of your capital in your self-custodial wallet. So like there are products coming to market that like do take this like crypto first backend approach, but deliver a product in its well understood form factor. So those are the types of innovations that I want to see, is just taking some of the features that crypto has as far as like self-custody, 24/7 settlements, and applying it to existing technologies to provide slight improvements. As far as like what can happen in a market structure perspective. So one, I think that like we need to accept that in most cases, applications don't need to be decentralized from day one. We can argue like at what point they do need to be decentralized. And for that reason, as well as like potential changes in regulatory that allow for equity, like most companies that want to have a liquid instrument should really consider launching equity as opposed to tokens. Like tokens create a lot of incentive misalignment, and you have a lot of history to show of this misalignment. And like, yes, there are some reasons as to launch a token, but like you just have to ask, like, will those reasons that you're currently underwriting to be valid in like 2 or 3 years? So I would say like creating equity is important. And also for that reason, like Binance, Coinbase, etc., they need to create a path for equity to trade on their exchanges. Like I just really don't have interest in hearing how like these tokens need to conform to not be securities because Coinbase can't list securities. Like, why not? Just become a broker dealer, offer securities listings. So I would say there's that. I think there are issues with the current market making structuring. Part of that is like market maker's fault. Part of that is the exchange's fault. Like when you offer the ability to list a token on exchange, but needs to be above a specific market cap, you're just asking for teams to like try to justify unrealistic expectations for their token price. So yeah, I'm happy to pull on any of those strings, but those are like a number of things that can be improved and things that are like currently being done that I think are beneficial to like the on-chain financial space.
I want to hear a little bit more about the market making token price, unrealistic expectations. Elaborate a bit on that.
Yeah, so I think this has become better understood over the past few years, but it's not necessarily the market maker's fault or the exchange's fault. I think it's kind of like small. Everybody's at fault to some degree. But from like an exchange's perspective, they need a specific market cap minimum to assume a specific level of turnover and volume that will come from a token. So like estimate, like if I list this token, how much revenue am I going to make? So the lower the market cap, the lower the volume. So there is this minimum market threshold or market cap threshold that has to be had. So that's point one. The second point is that Binance and other exchanges require market makers, which makes sense. It's similar practice in traditional markets. Like you need a market maker on day one to provide bids and asks. And so token issuers engage with market makers prior to TG, and they're biased to put the token at a high price because maybe it's they don't deserve the valuation minimum that the exchange is asking, but they want the exchange listing. Or maybe they want a high price to then have the market maker sell some of their tokens down to raise capital for the foundation. There are many different reasons. But the way that the market maker interacts is that typically a market maker is either going to be given a loan plus retainer or a call option model. And with the call option model, essentially, like I give market maker token or some percent of my token supply, I give them a call option along with that token supply so that if the price goes massively up and the market maker sells their position, they're not sitting on a massive like P&L loss. So like there's like real reasons as to why to do it. But the point is that like if I say like market maker, your call option is at 500 million FDV, I can feel pretty confident about what the token is going to do as it trades closer to 500 million FDV, and that like the market maker is essentially going to just gamma scalp. So they're going to buy below 500 and sell above 500 and pin price there for the life of their call option, putting aside like other market dynamics. And so like what you end up getting at is the exchange incentivizes the high valuation. The token issuer and market maker essentially agree to a high valuation via either like explicitly in the contract or implicitly in the contract. It's not always the case, but you tend to have tokens that get launched at high valuations that are relatively low float. And when the market maker's contract inevitably rolls over and they're assigning a new strike price, the strike price might be much lower, in which case the token probably isn't going to get held at that artificially high price for a very long time. So that's like one kind of insight into the games that are played for these TGs.
So then what is the solution to this?
It's a good question. I mean, like the solution is not to participate. Like if you know that there's an exchange there that is listing tokens that are trading at high valuations and are unable to sustain those valuations, and you have a large portion of the float that's essentially cornered by a quantitative trading company to facilitate price discovery, like that's just not conducive to real price discovery. And so like it's what you should end up doing is just wait a year. Like that's what we do. Like when a team launched a token, like great, I'll speak to them.
Yeah, if you have conviction, wait. I know it is like it's a foreign concept, but it goes a little bit to the point. I was messaging with somebody who brought this point up about like if you have really high, like, with regards to BTC underperformance by a lot of these tokens, it's like if you have insane conviction in some token, like statistically, you can wait 1 or 2 years and buy 10, 20x the number of tokens that you could have had. And it's like, it's hard to articulate this because it's not really the function of a mature or efficient market, but it's just something you can observe. Like you could just look and see that to be the case. But yeah, that is interesting. You just wait a year. But then, I mean, I don't know that I see much in the way of this turning around with these VC tokens. I mean, I don't know. We keep talking about, like, the market's punishing this. It's like, it doesn't punish this stuff very quickly. And there's so many reasons that there's just dead capital or a certain valuation that these tokens can be held at for a certain amount of time. And I don't know the intricacies of every single one of those, right? Like sometimes it's the founders are borrowing against their tokens instead of max yeeting them on the open market. Sometimes it's they've, done the most rigorous analysis on the tokenomics and the float that should be like let out over X amount of time. Like that's where they try to maximize their utility, right? Not in actually driving value to the token.
Yeah, no, I fully agree with what you're saying. I mean, the other solution is just bring in the regulators. I just don't think that's going to happen. But like, if you're manipulating the price of an asset, like just can't participate in the asset as like a retail participant or like a liquid market participant. Like there's what's the point? Like there's just downside on going short and going long because you just don't know what the market maker is going to decide to do with the price unless you know what the specific contract they engage with the team on. So yeah, I mean, I think it's a good point. And I also think that like the right answer isn't to wait a year. Like it's a bad market structure to say like teams can launch tokens. They have to wait a year to find out whether the market thinks their token's worth zero or not. And so like as a byproduct, you have teams that build projects, get hype because they list high market caps and have like just way too much attention poured on them. And sometimes because they get so much attention, you get copycats that come to market to take advantage of their high FDV that isn't real. So yeah, it's a massive waste of resources and like somewhat predictable as far as how it always plays out. I just, as a liquid market participant, don't see a way to stop it other than to not participate and allow a regulator to deal with it if they feel the need.
Also, going back to what we were talking about originally, another reason, just zooming out, why it's difficult to stop, this has less to do with the actual market making and exchange listings and more to do with just the industry as a whole, is that, again, if you're comping to Solana and if you're comping to Ethereum and those have massive valuations, then there's always like, why would an L1 that has a brilliant team behind it, why would they launch at $100 million? Like until there's some more efficiency with how we price these infra. I mean, I guess I'm talking more specifically on infra here because those have been typically where we have seen these very large raises. But I don't know. I mean, there's always that. Well, hey, this is the point that Haseeb was making. Like the comp we make to something like Monad is Solana, and it's like, okay, then I don't see this fixing itself, and that is tangential to the whole float and token design and year-long downtrend. So I don't know. It's like twofold there, kind of from my perspective.
Yeah, I think it's fair to assume that large portions of the market are mismanaging capital in one form or another. That being said, I think that like when you have capital mismanagement for a long period of time, regardless of whether it can sustain itself over that period of time, like people become more and more aware, and also the returns are harder to maintain. Just because, for example, like maybe I wasn't going to just actively not touch anything that is within a year of its TGE 4 or 5 years ago, but now I'm just not going to do it. So like market behavior slowly shifts, and like this is an unnatural long-term equilibrium. Like it's not an equilibrium. And so like on one hand, I do hear VCs and like understand that they're also playing a game where like there are a lot of VCs with more capital that may just be willing to pay a higher price. And so like it is an auction. That being said, I would implore like the whole VC market to look 3 to 5 years in the future and say like, what probability do you assign for this market structure to still be like this? And given that your fund life is probably around that, if not longer, like why are you choosing to participate in it? So like, it's just me saying like, I mean, the market's going to, sorry, go ahead.
I agree. I think you're spot on, but there's this, very obvious unlock they have, which is they can mark these tokens to, some discount, but oftentimes not nearly the discount that it should be, and raise a new fund. And they can just keep the cycle going. So, and this is something that I really didn't even touch on, but this is one of the big problems here is that you invested 50 million and it launches at $1 billion. Okay. I don't know what price those should be liquid, but they're not pricing it at the 50 million they invested in when they're going to LPs and raising fund 2. So, I mean, this is a market dislocation. It's a whole conversation unto itself, but like these are the problems that we encounter, right?
Yes. And I know we're coming up on time. Just briefly on this.
Yeah, go ahead.
Like the LPs with serious capital are fully aware of this dynamic, or a lot of them are in a way that they weren't many years ago. That doesn't solve the issue. I'll tell you why, but it's just to say like a lot of the like sophisticated fund of funds in crypto that are responsible for like allocating capital to a lot of funds, they're intimately aware and are actively choosing not to participate. And like you see the same thing in private equity as well. Like a lot of private market LPs just do not like the way that marks are being done and believe that they're taking advantage of. And it's created an industry full of like management fee oriented fund managers. The only thing that I'll say as to why like this dynamic plays out probably longer than it should is that a lot of the large pools of capital, like pension funds, their employees are partially incentivized based on their investments marks to market. And so they prefer to have a higher mark on paper because their annual salary is a function of the price on the screen. So like
everyone's involved in the pensioners.
Yeah, it's I mean, like maybe that's an overly cynical perspective, but I just think the incentives aren't aligned in some cases for like large LPs where the people that are making the allocation decisions aren't paid based on like the DPI in 10 years. They're paid based on TVPI.
Don't a lot of funds just give the tokens directly to LPs?
I'm less knowledgeable about that. I know that some in-kind distributions have been made in the past, especially for things that like had the potential to crash the token if they just sold it on market. That being said, like a lot of LPs aren't sophisticated enough to like take receipt or have like the ability to. So like most of the time in the situation that like you can take physical receipt, like the funds will give the ability to opt in to just settle and take the cash.
Yeah, that makes sense. Okay, well, anything else? Thought we covered a lot.
No, I think this is good.
Okay, awesome. Well, thanks so much for coming on. Where can people, excuse me, where can people find you?
You can find me on Twitter at Trader Noah.
Awesome.